Hi, how's it going? How are you all doing? Welcome to this fourth stock market Q&A session. Today we want to start by talking about something that in fact was a topic of debate just yesterday within the WS financial research community, which was an article by QP. In that article, he didn't just do a quick analysis like, stick a finger in the air and say, "Hey, artificial intelligence is reaching bubble-like levels," right? Instead, he talked about data, about the capex required for investment, about the numbers, about the returns. We discussed how the big companies have to build data centers. Yes, okay, but building data centers means land, facilities, and honestly, the numbers just don't add up, right? You commented on that article, Albert. Tell us about it.
Yes, it's quite interesting because we often lose perspective on valuations, right? It seems like the stock market is just a number that goes up and down and doesn't mean anything, but there are assumptions behind it. In fact, this is something we work on a lot. And for example, in the roundtables, Edgar does this often, right? Doing the reverse exercise, right? Which is to figure out what the market is pricing in based on a valuation to see if those assumptions make sense or not, whether they're optimistic or pessimistic. Obviously, it works both ways. And so Kupi brought up a couple of three ideas that I found quite interesting. The first of these is that in this frenzy of capex, we're seeing, well, in the new earnings presentations, Microsoft, Meta, Google, right? The usual suspects are announcing ever larger capex plans. So that's already a first paradigm shift, which is that these companies, which used to be what is known as asset light, right? Or that didn't require a large investment in assets, especially in fixed immobilized assets, right? Let's say, because sometimes in intangibles, acquisitions, brands, there was more of that, right? But above all, intangible physical assets, they didn't need a big investment to achieve astronomical returns. Well, that's changing now. And when you start needing to reinvest a large part of what you generate, your multiples tend to contract, right? This is a well-known principle. And I think it's been mentioned many times as well by Buffett, etc., about the advantage of those companies that are capital light or don't require much reinvestment, right? The opposite of industrial companies, which need to reinvest to maintain their returns in the future. That was the first idea. And the second is that he said, hey, let's do some back of the napkin math, right? QP isn't known for highly detailed models, but rather for general ideas or broad strokes and being directionally on the right track. You don't need to get into the details, but at least you should be heading in the right direction. And what he says is, of course, if I add up the cost of a new data center and divide it among the components that make it up, which, as you mentioned, includes the land, some hardware like fans, cooling systems, etc. And then there's a part that's just chips. And if I look at the lifespan of each one, I can create an amortization schedule. And with the associated costs, it turns out that in order to justify a reasonable return, not even talking about something astronomical, but with a 10 to 15% return on invested capital, this requires a level of income that is hardly attainable, or at least seems 10 times higher, right? Which is what NVIDIA is currently generating in terms of users, in terms of fees, and so on. It could be that governments, as he mentioned, or companies have a different sensitivity to price and end up paying it. But anyway, it was a case where the returns this could have are not so clear. And he compared it to a scenario we've already experienced, which in no way questions the technology. For example, in the case of the year 2000, right? With everything related to fiber optics and the internet, many companies that invested in infrastructure were, well, capex heavy, right? They had a large amount of capex, like in this case here. And in the end, well, they went bankrupt or didn't do well at all in the stock market, because it's one thing for the technology to make sense and another for it to make sense as an investment, right? And then the idea is that by combining these, large companies change their business model to one that requires much greater investment. And then on top of that, the return on this investment isn't clear. So this could lead to a significant contraction in multiples, especially when we're starting from demanding figures like we have now. So I think it's interesting for everyone to read it. It's not technical, but it does make us think, or at least consider these ideas from a different perspective.
Yes, he gives the example. I've shared the link for those of you on YouTube, and I'll share it with everyone on all platforms in case you want to check it out in the chat. He gives the example of Global Crossing, which was a company dedicated to something that is still in use today, laying fiber optic cables in the United States. They flooded the US market with fiber, which is still being used, but the company itself no longer exists. It went bankrupt. So, in the end, was it clear that the internet was going to change the world? Yes. Was it clear that those fiber optic cables were needed? Yes. What happened? The company, well, it reached a certain valuation, it took on debt, and well, everyone assumed that since fiber was important, any price would be paid for it, but that just wasn't the case. So, well, I don't know, Albert, connecting this fascinating discussion to what we've been thoroughly discussing for the past couple of days, when we typically show the comprehensive heat map and we then scroll back and clearly see, hey, the overall market is either significantly red or vibrantly green. It consistently seems like the prominent technology companies are deeply in the red, while the various non-tech companies are comfortably in the green. What could be the reason? Because it's not like a lot of people are saying they don't know. It could be that rebalancing from tech positions to non-tech, that thing people have been talking about for a long time, the return to value investing and so on. But it doesn't really seem like that's happening in August, does it? Everyone's on vacation. The big funds are on vacation. It's strange, isn't it?
Yes, at the very least, it's premature to draw conclusions, let's say, about general trends. It all seems to have started at the end of last week with some comments from Sam Altman, right? The CEO of OpenAI, where he himself said it wasn't clear what the returns would be on many of these AI investments, right? And sometimes we think of a big catalyst for a change in trend as something that has to happen, well, like what we sometimes talk about, right? A war, a major crisis, a collapse, and so on, right? Something that makes people change their mindset. But often none of that is actually necessary, right? Sometimes it's just that at some point, well, the music stops playing, as they say in the game of musical chairs, right? And people realize there aren't enough chairs for everyone, right? That marks a paradigm shift. For me, it's too soon to say that this has already happened or that we're in the midst of it for the reasons you mentioned, right? We're in the summer season. We've only been at it for a week, right? After months of a vertical rise, in other words, it's a time for a bit of calm and perspective. But anyway, it's definitely something that I think will end up happening for exactly the reasons Kupi explains in his article, right? Because it no longer makes economic sense. And investments, aren't just numbers on a screen going up and down. Behind them, there are businesses, companies, and expectations of returns from investors who are putting their capital there.
Mm. Albert, you've also had extensive discussions with us. Actually, when the stock was trading significantly below $20, we've certainly seen its value dramatically increase, and now, unfortunately, it has gone down again. This is ASTS SpaceMobile, and at this particular moment, it truly seems like all the initial optimism from just a few days ago has regrettably transformed into a pervasive sense of pessimism. Wouldn't you agree? Or let's say the optimism is tempered, especially because there was kind of there were some launches scheduled, as we mentioned the other day in the roundtable. I was analyzing the results of some satellites, FM1 and others, and it wasn't very clear. It was expected to happen in August, and now it seems they've definitely postponed it to January 2026. These were mainly some launches that were going to take place in India. So how are you seeing things? How are you keeping up with everything that's happening with the company?
Yes, look, Antonio, if you also pull up the chart on investing, so we can see the tremendous rise it's had. It's a stock that, as you know, has basically gone up almost vertically from 20 or even a bit less, like 18 or something during Liberation Day that week, all the way to almost 60, right? In 2 months, a truly vertical rise. And the first thing is that we always say you have to manage your positions, right? It's not enough to just have good ideas, etc., which is obviously reasonable and important, but then you also have to know how to manage your portfolio. In fact, in research, we just did an analysis on how to manage a portfolio because it can save us a lot of trouble or, above all, maximize returns, which I think is what's really important, right? So this stock has had a vertical rise, and no matter how positive the outlook may be, etc., when a large part, as we say, is already priced in for the short term, and above all, when you've had a very stretched momentum from a more technical point of view or in terms of a vertical climb, then it makes sense to manage this. How have we done it? By selling calls, right? Taking advantage of the high implied volatility. We can also look at it in options strat later if you want, and it made sense to manage it. As you said, there have been some delays in a few launches, not because of the company. They already have them manufactured, and in fact, it seems like they're really picking up speed or momentum in building them, but rather on the part of the space agency that needs to be involved in this. So from what was said today, a part of the test, as you mentioned, is being pushed to Q1 2026, but that shouldn't necessarily affect the rest of the launches. So what's the problem with these stocks that for now aren't generating any returns? Well, the issue is that as soon as the catalysts slow down a bit or there's some delay or problem we see drops, to a lesser extent, we also saw this, for example, with a completely different company from a sector that's unrelated, which is Adriatic Metals, right? They just finished building the mine, and it seemed like the catalyst, the ramp up, etc., were taking a bit longer to arrive, and the company went through a somewhat neglected period, even experiencing some declines and so on. Eventually, it doesn't matter if someone looks at where it is now, right? After the takeover bid from Dandy, you'll see it's at all-time highs without any problem. But anyway, These are things to keep in mind. Nothing goes up in a straight line, and usually there are delays in operational matters. Things rarely go perfectly unless you're working hand in hand with the Londons.
I've just shared on screen that, as you know, Investing Pro, the platform we're currently showing, provides a lot of information about stocks, charts, news, and so on. Well, it's currently on discount until the end of summer with 50% off. And if you use the code LWS, that discount on the Investing Pro platform increases by 15%, so you'll get 65% off. The truth is, it's a really useful platform, and there I've put the QR code for you. You also have the link in the description just by entering the QR code, the LWS code. So let's also take a look, as Albert was saying. I'll stop sharing here, and since we're going to share, now you can see options strat, right, Albert?
Yes.
So tell us, what were you saying you were projecting here?
Yes, look, well, now obviously it has dropped quite a bit and things are different, right? But when this was going up vertically and was close to 60, there was the possibility of selling covered calls. If you, for example, look now that we're at the end of August, for a month out, for example, the ones expiring on September 26th are great. And if now the stock is at 44, then 10% out of the money at 49 would be perfect. And look at the premium here, Antonio, that you get for selling this stock. It's quite significant because, of course, someone might think, how much is it? 280, right? The last time?
Yes, indeed. That is precisely 281.
Okay, for a month, it's giving us 280, which is almost 3 out of 5. So that would be 6%, right? A little less, it would be a bit over 5%. Someone might think, hey, well, 5% isn't that much, and so on. Well, if we normalize this, you'll see that it actually gives you well over 60, which is a pretty reasonable return. So when we have vertical increases, and on top of that, the fundamentals have usually already moved ahead, it always makes sense to me to hedge part of the position. Does this mean cutting off all the upside and not leaving any room for further gains, even if a catalyst plays out as expected? No, but if we have a position, say, of 300 shares, then hedging a third makes a lot of sense to secure a yield. You have to treat it like a dividend and always as a financial decision made in advance. What does that mean? Well, you don't have financial risk if it's a covered call, but you do have economic risk. In the end, you could obviously be missing out on upside, right? So it's never really free. But with stocks, we usually swing from euphoria to excessive pessimism and tend to extrapolate recent trends. We think that if something has gone up 100% in 2 months, it's likely to do it again in the next 2 months, and vice versa, right? When something is falling, we think it won't stop falling. And usually there's always a reversion to the mean or at least a period of rationalization. So there are options. The others that we discussed in the research and that were interesting when the stock was higher, right? For people who wanted to get in, who didn't have a position, and so on. One example was to buy shares and sell out of the money calls 20 or 30% out. But for 2027, for example, we have them here for January 2027 and so on. We've bought them at 52, 53, sold a covered call at 80 or 85, and they gave us $19, $20. Now, of course, they've dropped, right? But even so, they're still generous, aren't they? 977, but this is already going to pay me double. So you are basically securing yourself. You are effectively buying at around $34 or so, and you had, or looking at it another way, you had the upside up to 100 and room to run with the stock. Does it make sense to build everything like that? Probably not, right? Because you're capping part of it. But well, these are interesting things when volatility is so high. I don't know, Antonio, if you played any of these.
Yes, I let's see. I always there are some rules with stocks that are, let's call them explosive, okay? When there are stocks that can be explosive, they're explosive either to the upside or the downside. So options are the ideal instrument. It makes me laugh when people say, no, options are an instrument. Look, for example, we can all agree that ASTS, and when I say all, I mean both the bulls and the bears, we can agree that ASTS could be a stock that, if everything goes perfectly, the so-called best case, it's a stock that could easily be trading in a few years at $300, $400, right? And we can also all agree that if the technology doesn't work, it's a stock that could go to zero. So where is the difference between the bulls and the bears? It lies in the fact that each one assigns a different probability to those two scenarios. So right now, in the current situation, for example, what do I suggest to people who say, well, I want to be able to participate in this potential upside, but, still play it safe? What would I do? I could easily sell a put, taking advantage of. Let's proceed to remove this particular one. For instance, consider selling a put option perhaps at a strike price of 40 or even 42, which would typically provide you with a fairly decent premium amounting to approximately $255. Okay, even though implied volatility has dropped a lot, which honestly surprises me given how much the market cap has fallen. Okay, and at the same time, I could also buy a call around here, for example. All right. Now, what does this position do? It costs me $38. And if I say, well, I don't want to risk losing it all, I go and buy a put at 35. Basically, I'm taking a bullish position for $100. This is what it costs me. It's nothing out of the ordinary. In fact, you might say, well, I want it to be even cheaper. All right, then I sell a call at 55. You say, okay, the company could go up $11. Well, it could go up, or if not, set it further out in the long term. Look, not further out in time, but a higher strike. Sorry, I mean, we're all in the same expiration within a month. This position costs you $40. Where would your worst case scenario really be? Well, that you lose at 35, that's it. Well, that's what you've lost. But look here, this range is very interesting. For me, it's very interesting. Here, we would have to zoom in a bit on the chart because notice that it tends to look like the profit is unlimited when it's not. There comes a point where it's capped. But to me, these kinds of scenarios where I have the risk side, especially capped, seem like a reasonably smart way to play these positions. These positions, which I repeat, I think both the bulls and the bears agree that it could go to the sky or it could go to hell. The only difference between us is the percentage we assign to each outcome. Albert, we already have a lot of questions there. So do you think we should start firing away?
Yes, great. Look, I've seen a few, Antonio, and if you want, you can also send them in.
Let me first send a greeting to Bentin, who has given us a, I don't even know what this is called. I should bring my son. I don't know if it's called a super chat or something. I'm a bit of a boomer. But anyway, hey, Bentin, thank you very much for your contribution. Okay, go ahead. Tell me. Action.
Look, if you put, because we have several from the petrochemical sector, okay? If you want to start there, then we can compare them. If you search, for example, LYB,
Yes, actually, LyondellBasell, correct, right?
and if you also look up in competitors, yes, and you can also search for competitors or add comparisons if you want while we look at the Braskem part. Yes, for example.
Okay. Well,
Okay, it gives you some like Dow, etc. I don't know if you can add Braskem here yourself.
yes, that is absolutely correct. And I fully agree.
Okay, and you can leave if you want, just LA Braskem and also Dow.
There, I removed Dow, which I think was actually a good competitor.
Okay, we'll add it now. Well, for those who don't know what this is about, these are companies in the petrochemical sector, and they're all going through a. It's this one, right? Let's see. Yes, this one. This one's good. Yes, and they're all really going through what's it called? A pretty big rough patch, right? Obviously caused by the sector. What problem have they had? Well, the usual one in the capital cycle, right? They had some very, very, very positive returns. And a second cycle that was in the 2017, 2018, and 2019 period. Then a second somewhat false cycle, which was in 2021 and 2022. As you know, all commodities and derivatives were very bullish for non-fundamental reasons, and that also led, in addition to the extraordinary returns, to the fact that even for those who are bearish on oil, as we were just saying with AST, Antonio, even for those who are bearish in their thesis, they do agree that one of the areas where demand is going to grow more or less steadily and continuously is in the petrochemical sector. So the good outlook for the sector and the bullish cycle they experienced led to a lot of overcapacity being built. The main problem came from China, as is often the case. And so these companies have suffered a great deal. The drop they've experienced has been enormous from their highs. Braskem was at 25, now it's at 280. In the case of ELP and Dow, which are of much higher quality and don't have balance sheet issues, nor did they have the specific problem of, well, not so much. But still, in any case, they've suffered quite a bit. So we have a few questions here. And the first ones, Josera asked us, what do you think of LyondellBasell and OCI? In the case of OCI, since it sold many assets, we're not going to focus on it as much, but with Lyondell, we will make the comparison. And Pablo Postigo also said, Braskem mentioned in its Q2 presentation that there will be an oversupply in the petrochemical sector until 2030. Would this mean that the stock will go through a dry spell until 2030? And we had another one.
And there's another one, right?
David also asked us, can you explain the petrochemical cycle and where we are in it right now? All right, so let's combine all of them because I think they make sense together. In the end, these are commodity companies. What does that mean? It means they all produce the same product, right? There's no differentiation. It's not like someone selling an iPhone and someone selling a Samsung, right? Obviously, there are differences between the two and you can choose based on the features. Here, what they produce are derivatives of hydrocarbons, and I won't say just oil because we'll talk about that too in a moment. Well, you can think of plastics, right? Polyethylene, propylene, etc., and all the uses we give to these every day. I recommend looking at the company's presentations where there are really many, many examples. So as I was saying, this has very strong tailwinds for demand. This is expected to keep growing. It doesn't have a technologically and economically viable substitute. And the difference between the companies comes down to two things. The first, obviously, is the balance sheet when you enter the lower part of the cycle because there is an excess supply. That's what, when we talk about cycles, David, is a capital cycle, which is when there are extraordinary returns, there's overinvestment in new supply, and then that depresses future returns until demand once again surpasses supply and we have another period of extraordinary returns. So what matters here is first the balance sheet. In the case of Braskem, for example, which is very, very, very damaged by the debt it carried, and especially by the geological disaster that occurred in one of its mines, which is forcing them to pay out a large amount in compensation, etc., which has significantly weighed down their returns and balance sheet. And then the efficiency of the plants. It's not the same if they're fueled by naphtha, for example, which is less efficient than other sources like ethylene, natural gas, etc., which are much more efficient. So in a commodity company dealing with raw materials, what you always have to look at is where you are on the cost curve. That is, whether you produce more cheaply or more expensively, and whether you really have any unique or distinctive asset, like in the case of Israel Chemicals, that can protect you or give you a certain defensive mode, which is not common here. So Dow and ELP have much higher quality in terms of assets and efficiency compared to Braskem. In Braskem's case, what's good about it is that extra leverage if the cycle turns, right? If we really start to see better prices, the key metrics in the petrochemical sector are obviously volumes and then the spreads, where a spread is simply the difference between the selling price of the final product and the price of the input or what it cost them to produce it. So those are the two key metrics, which seems pretty logical to me. And we're at a point of a complete trough, right? Of right now, almost all of them are losing money, burning cash, especially in the case of Braskem, which is quite significant. And so when everyone or almost everyone in a sector is losing money, it tends to be a good time to look at it and start studying it. As another colleague also told us, even Braskem mentioned in its presentation that the petrochemical sector will face Chinese overcapacity until 2030. The issue here is that they don't produce all types of end products, and also many regions or countries are imposing tariffs to prevent dumping, because in China's case, they're not operating at full capacity utilization, but it doesn't matter to them because they're subsidized, right? So what this does is allow them to gain market share now at the expense of driving competitors out of business, and then benefit later when the cycle rebounds by having all the market share themselves. Obviously, countries believe this is not a reasonable or fair practice, and therefore they impose tariffs or trade barriers. The case of Braskem is interesting because Brazil still hadn't implemented them, which is why they're suffering more than others. But for example, in Europe, we already have them in place. So this week, there was actually news that China is going to start reviewing its overcapacity and shut down plants that are not efficient, and that also depress returns for everyone. And that, combined with the tariffs, in my view, will prevent a long dry spell until 2030. The advantage of choosing one or the other is that in the case of Leap and Dow, you have a much, much, much lower risk of bankruptcy, right? Because you have a very healthy balance sheet, you can hold out much longer. And in the case of Leap, well, in the meantime, they pay you a pretty attractive dividend. We can see it here.
That's what I was going to say, huh? But is it sustainable? Do you think this dividend, this 9.9% dividend, is sustainable right now?
In terms of cash generation, no. That is, if you look at it now, what they're generating, well, and with the drop, in fact, you can go into here on investing itself, which is where I check. Antonio, if you go to Leap, not in the comparison, but just to Leap.
At the very top of it all?
Yes, higher up in the company.
Ah, okay.
And here, you're doing well, and then click on financials. Here. And where it says statement, change it. Here. And select the cash flow statement. Okay, here, as those of you who know a bit about accounting already know, here you have the cash flow statement. And we can see that in 2021, 2022, this was generating 8 billion, 6 billion, and this has been dropping, right? In 2024, it was 3.8, and this year it has dropped even more. They have to allocate about 2 billion or so to CapEx. And then you have the dividend part, right?
It's just that they are burning through a lot of cash with the dividends, aren't they, really?
In previous years, no. If you, for example, click on the cash flow, you'll see that's not the case. The thing is, this year, yes. Their balance sheet allows them to maintain it. And in my opinion, they're going to be able to get through the whole cycle with this dividend, although it's likely they'll cut it a bit along the way. Even if it gets cut in half, it's still 5 or 6% just to make sure they get through the cycle smoothly. But they could keep it because their balance sheet is in good shape. Although, honestly, it probably wouldn't be the smartest thing to do.
Conclusion, a sector to keep an eye on. If you want to play it safer, LyondellBasell has a good balance sheet. And if you want operational leverage on your side, Braskem. Obviously, this isn't a recommendation of any kind, but
That one really does carry a real risk of bankruptcy if this drags on.
all right, very good. Let's continue. Wow, a lot of questions are coming in. I don't know, Albert, which one do you want? I'll start throwing them at you. You just let me know.
Perfect.
Look, we're also getting a lot of questions about the oil sector, which makes sense because whenever people ask about it in the Sanhedrin, we always refer them to your area. Here, Oscar is asking us about Cosmos. Del Olmo was also asking us about Saturn today. It's a very cheap, but I was thinking about taking profits. It has performed well on the stock market. Today, I also think that Aramco, the CEO of Aramco, made some rather bullish statements about oil. What do you think?
Well, look, first, speaking a bit on a macro level, let's say it's likely that oil won't perform very well in the short term because several circumstances have come together, right? The first is that obviously the economy has slowed down. We've seen it with the tariffs, we've seen it in China and so on, right? And that obviously is one of the variables that affects the demand for oil. So it doesn't help. And then on the supply side, we've been saying for a long time that low prices are the cure for low prices, and that this has already affected capex campaigns, which will start to be seen from next year. The effect won't be as significant this year because the spikes we've had, for example, with the war in Iran, etc., have allowed many companies to take out hedges at higher prices, IPCO among them, right? IPCO is a company we follow in the Locus to Wall Street universe, and it has set up hedges taking advantage of these volatility spikes. What that does is that the expected drop in production doesn't happen so quickly and so on. That said, I believe that in this decade we are going to see new all-time highs for oil prices because there is ongoing underinvestment. And in fact, even the IEA said last week, this is in our email, which is also free, that it's likely that next year supply from non-OPEC countries will already start to decline. All right. In other words, growth is no longer expected, but rather a decline. So when supply stops growing, at least from the non-OPEC side, and as for OPEC, I would say there isn't much room either, except perhaps in Saudi Arabia as well. So even if demand increases just a little, if it keeps growing, which is the consensus, everyone expects it, as we saw with petrochemicals and so on, eventually there will be a market deficit and you won't be able to react until prices are much, much, much higher. So I still believe there is a bullish case for oil. That said, let's move on to the companies that have also reached out to us, right? In the case of Saturn, well, the opposite affected them negatively. They had some hedges that weren't very favorable and didn't allow them to take advantage. But looking at the current situation, well, they're not that bad. As they say, it's cheap. They made a tender offer for shares and so on. I personally like it quite a bit. And as for Del Olmo, obviously, we can't recommend that you buy, sell, or anything like that. That's a decision that depends on each person, your risk profile, portfolio, investment horizon, and so on. But if you're bullish or also believe in an oil cycle, well, a bullish one, then the case of Saturn Oil is a good way to play it. The truth is, it's very cheap. And when these not so interesting hedges also expire, well, it could really take off. And regarding Cosmos, the catalysts you were asking about, look, in Golar's earnings presentation, they already said they were considering increasing production capacity, right? Even beyond what they have contracted, the nameplate capacity, or what they have been assigned industrially. And that will be a major catalyst. And the second is that they're starting to fix the problems at Jubilee, the field that had been problematic until now, and production has started to increase. So the combination of both, for me, are the catalysts that will start to show up from Q3 and Q4 in the results. And what this company really needs is simply to deleverage. Right now, it's trading as if it won't get out of this without a capital increase or worse. And unless oil drops to 40 and stays there for a long time, which is not my base scenario, otherwise I obviously wouldn't be interested in oil, I think it's going to do well.
Look, Albert, there's also a question from Alvaro Rosado who says he wasn't familiar with Expro Group, which is a company in the oil sector that focuses on the construction and maintenance of wells. What do you think are the key things to analyze in this type of company?
Well, I don't actually know it. Obviously, just like the person previously mentioned, in the specific case of Expo Group, from what it clearly seems you're saying, it would indeed be an onshore drilling company, wouldn't it? Instead of doing offshore work out at sea, what they do is provide support on land, at least from what I understand from what you're telling me, right? Things like pipes, maintenance, and so on. So the important thing here, or the things I would focus on, apart from the balance sheet, the returns they have, margins, etc., is also especially the regions where they operate. Okay, because of course, if they're operating in areas Well, you can also ask Antonio about this, ask him which regions they operate in, and so on, right? For example, if we say that shale is collapsing in the Permian region and in other areas of the United States, in the foreland, in the back end, etc., and they only operate there or only have competition there, then it wouldn't be as interesting, right? If they're in other regions or have exposure to areas like Africa, etc., then it would make more sense. You're absolutely right to use Warren here as well, because he can at least give us an initial overview of all this in a simple way.
Yes, yes. Here it says indeed it does what you mentioned, right? All the stuff related to wells and so on, onshore, not offshore. And indeed, not just North America, yes.
Beyond the United States, that's interesting. Latin America, there's a lot of opportunity. Africa, the Middle East. So it seems that their geographic exposure could actually be more interesting. So what I would say is that normally, if it's an industrial company or it doesn't have unique assets, like in the case of Valaris or other offshore companies we've mentioned, look at what returns they have. They shouldn't be too high. Here in Spain, we have a similar example with pipes, right? Like in the case of Tubacex, look at the order backlog they have, how competitive they are. Obviously, that's important. Reputation is it's key in these sectors. In the end, these are multi-million-dollar projects that require trust in the supplier you're working with and so on, as well as the regions in which they operate. Those are some of the qualitative factors. On the quantitative side, in the end, unless they have their own technology, in this case, if they are tubular services, cleaning, etc., which are simply services, it's not like the case of Tubacex, which might have its own technology, etc. They won't have much of a moat. So what they offer will also be a commodity.
Albert also asks us, well, I was going to say two users. No, it's the same. It's Mariano Solis who mentioned Vermilion Energy. Thoughts on it?
Look, this is an interesting case because it's a company that has performed very poorly. It behaved a bit like another company we know, which is the case of Kistos, because both were vehicles to gain exposure or that people used to gain exposure or as a proxy to the European TTF, to European gas. And since September 2022, when it peaked, as you can see, it must have dropped by about 60%. We'll see it now, Antonio, but it should be around there. The company produces both natural gas and oil, and as I said, one of its main appeals was that it offered exposure, and quite interesting exposure, to European natural gas. Since then, what has happened with the company? They had a very bad 2021 and 2022 because they didn't take advantage. They had relatively high leverage and couldn't return capital to shareholders. And then, of course, we saw in Europe the problems that arose with extraordinary taxes, the windfall tax, etc., which prevented them from taking full advantage of the TTF price surge, which later corrected anyway. It's a company that overall is well managed operationally. They always meet their production guidance. They do reasonably good hedging, etc. And recently, they've decided to change their production profile from oil or mixed, let's say, to almost entirely gas. And a large part of their gas exposure is in Canada, where it trades at much lower prices than in other markets. That's because up until now, it was a captive market, but they've already started exporting NG as well. And once this happens and things normalize, I see a bullish case for all natural gas in the United States and Canada. So for me, they've made a reasonable pivot, right? Moving really to natural gas gives a dividend of 5 or 6% at current levels. It also does buybacks and pays down debt, and does so at a pretty fast pace. So it's a company that right now isn't of interest. Nobody's interested in oil, nobody's interested in gas, and even less so in those that don't offer an extraordinary double-digit return, etc. And with the exposure to Canada, even less so, but I like it. It's well managed, and I think they've made a pretty reasonable change, a reasonable pivot. As we can see here, they've been increasing the dividend, and now it yields 5 or 6%, which is perfectly sustainable. Operationally, they're quite good, and you have exposure to both European and American natural gas. So it's a company I like quite a lot.
Another old acquaintance, Javier Gonzalez. Well, Gon's Q&A. Did you like Dynacor's results? Less volume, but the expansion is progressing at a good pace.
Yes, I like them both financially and operationally. It's fine. In the end, we already knew they had less volume. They reported it monthly. From now on, it will only be quarterly, but we used to have it monthly. I mean, this was already known and better than expected in some cash and profit metrics, worse in others like margin and obviously volume, and they cut the guidance. They gave us new information where they told us that there had been some government bans on processing ore for a few months, right? And so what this had done, artisanal mining, I mean, was led to lower volumes. This is what I didn't like because they hadn't told us about it. If they had explained it, there wouldn't have been any problem. But why now and why like this, right? So obviously there are a lot of transparency issues on the part of management. It's something that clearly needs to improve and that will help them. But anyway, it's a company that's very, very cheap, as you know. Gold has a lot of tailwinds, and I think it's more likely we'll see it go higher rather than lower. And the expansion, as you said, is progressing well. And now we'll start to see things in Ecuador, and after that, we also have the pilot project in Senegal. So there are several catalysts for the end of this year and the beginning of next year, especially, and it's looking very good. You, Antonio, I don't know if you're also still following it. You're still leading it.
Yeah, I take it. Dynacor. Let's see. Dynacor is one of those companies that I use a bit. Is I don't know if rightly or wrongly, and the comparison might be a bit unfair. Okay, but companies that I want to be a bit of the backbone of my portfolio, that very talent marvel kind of part that provides, but that doesn't have too many ups and downs, and that I think, well, it's just a matter of time before it's worth much more or the market values it much more. And I was saying that the comparison might be a bit unfair in the case of Golar. That is, I think, in the case of Golar, I think the downside is still much more limited because of the contracts and so on. And it's true that with Golar, we could easily go through a couple of years of wandering in the desert. It will depend on how proactive management is in announcing things or in wanting the market to reflect the value. But I think Golar is a safe investment, and Dynacor, well, I also have it in that part of my portfolio where I hold a relatively significant position and don't trade it. I just wait, as you said, for the company to keep executing, right? That's not really my approach. And honestly, with these kinds of companies, I almost don't even look at them. I hardly even know Dynacor's stock price because I have it in my do not trade sheet. I don't know. What do you think? I'm not sure what you thought about the comparison with Golar. Do you think it's accurate or not?
Yes, I obviously like, as you said, the downside more and how it's capped in Golar's case, but well, I get the overall profile, and yes, I see it's similar.
They're asking us about more companies, Albert. And I've asked you about the ones I know you have an opinion on that could help the community. The next one, let's see. They're also mentioning, look, Gonzalo Fernandez, ASPI. The other day, I tried to check out the Max Payne website. Well, so now I'll try to look it up for you on Max Payne and Zing. Zing is reporting results today, right, Albert? Or am I mistaken?
No, I'm really sorry, my Antonio.
I think I'm mistaken. Zing, no. How do you see the whole shipping thing, Zing? Do you play it? No, you don't.
No. I already stopped following it. I did obviously see recently the catalyst, let's say, or the news that came out, right? About how the board could make an offer to take over the whole company. Well, in the end, it could make sense, or I see how it could make sense. What happens is that in the case of containers, people were betting on a simple idea, which was route disruptions, and it was expected that this could offset the huge increase in supply that's coming to the market with new ships, right? The reality is that probably not, and we're actually seeing how freight rates are really, well, taking quite a hit. They've dropped to less than half since the peaks we saw not long ago, maybe a couple of quarters ago, a bit more. And so, as I said, I don't follow it anymore. But, well, I did find the rumors about a buyout by management interesting, and that could definitely be a catalyst.
They reported yesterday, actually.
Yesterday.
So, well, it seems the company didn't take it very well today. But as I said, it's a company we've also stopped following a bit for the reasons you mentioned. Now, the shipping sector right now is a sector that, if you saw the last roundtable, it's a sector where, if you know it, you should start looking for where you might want to focus your attention. It's a bit like what Albert was saying earlier about the petrochemical sector. Hey, it doesn't mean you have to invest in petrochemicals right now, but when it's really down, it's time to start looking at it. In the case of shipping, it's kind of the same with the different subsectors. And now those in the know are saying it's time to start looking at the tanker segment. The other day, look, Albert, I don't know if you knew about this. Honestly, it's pretty funny from Investing Pro. Did you know that here, if you click here on the PDF, Zinc Pro Research, it shares a sort of, well, like a one pager, though in this case, it's not one page, it's 10, but it even includes a lot of data and so on. It's pretty funny, isn't it? I don't know if you knew about it.
Yeah. I've used it once, not for CMA, but for the usual charts and so on. And as we always say, this doesn't replace all the work you still have to do, like getting to know the sector and so on, but it does give you some interesting initial insights into what's important, what isn't, what the consensus is, what analysts think. It's a pretty interesting summary. Investing Pro really gives you a lot of tools to get started, honestly. As you mentioned earlier, one problem with shipping has also been that, as you know, there are several segments, right? And they're also separated from each other. You've got containers, dry bulk, tankers, LNG, and so on, right? And the interesting thing is that usually each one has its own capital cycle, and you can play one, then another, which is interesting. But in recent years, many of them have become synchronized. So now there has been a period, and there is a period when new supply is coming into many of these segments. And so you get a bad cycle period synchronized across several of them, right? After the big rebound in shipping that we had from 2020 to 2022, which was a real party for the whole sector.
Look, for example, compared to a year ago, Teekay Tankers, which is a standard one, right? A classic one. Well, here you have how it has performed on the 1-year chart. Albert, more questions? There are questions that I no longer have control over the companies. I don't know if you look, for example, Andres Gomez, Trilene PLC, buying back shares, duopoly, reasonable valuation.
No, I write all these down to look into them, but I don't follow them. I also see here that someone mentions Atcore. I don't know that one either. Soundhound AI, neither. In this case, a bit more with ASML. What problem do I see here, right? And it's that in the end, well, you already know it has a monopoly, a completely leading and outstanding position in the manufacturing of the machines, specifically of some of them, right? In chip manufacturing. And the problem I see with calling it a safe long-term bet is that I actually see it as quite the opposite. I'm not saying it's going to do well or badly, right? Because obviously I can't know that. What I am saying is that when you have a current monopoly with returns like those ASML has, etc., and it's also a strategic and dominant position because, for example, this is a company based in Europe, right? And therefore it's aligned with the Western bloc. There are countries or other blocks, and in this case, I'm thinking, for example, of China that would love to be independent from ASML and not only have the same technology, but even improve upon it. Obviously, for now, ASML is ahead. There are even some restrictions on exports to China, etc., as you know, but they have an advantage. This isn't necessarily going to last forever. And in fact, the incentives for China are all the opposite, right? They don't want it to last forever. They want to be independent, even to serve an entire bloc that's not aligned with the West. What's more, this could actually happen as we've seen now with NVIDIA, right? With export restrictions, etc., and that affects the company's returns. So now you're facing the fact that you have the government's attention, you're a strategic asset that could face restrictions, and your clients want to replace you and move away from you. When you're trading at 2 or 3 times earnings, it's no big deal because you think, well, it doesn't matter, I'll just wait and I'll recover quickly and easily. But when you're trading at a demanding valuation, like in the case of ASML, then you could start having problems if any of these negative factors actually materialize. So when you talk about a safe bet for the long term, I actually see the opposite because at best, in the end, you have a limited number of clients and a bottleneck in demand, and your valuation is already demanding. What can you expect? An improvement in fundamentals of 10 to 15% per year, and for the multiple to stay the same, right? In the best case scenario, you get 10 to 15% compounding, which isn't bad at all, but you can find that in many other companies. And in the worst case scenario, you have negative asymmetry. You have export controls, real problems of being in a trade war or a large scale cold war over technology, and therefore many downside risks, right? So for me, you have negative asymmetry.
Albert, tell us what you are working on or what we are working on now at LWS Financial Research. That is this week's article, what is being worked on for the subscribers. This week specifically, we delivered a report where, as Edgar always says, Georgia Capital isn't followed by anyone. There isn't a single analyst covering it. There's one who assigned it a valuation a long time ago, and we've just released a very professional report on the pharmacy sector, which has been very well received about the pharmacy sector of Georgia Capital's holding. That is, it's just a glimpse. Tell us, what are you preparing or what are you all working on?
Yes, look, if you want, you can also put up some background information on Georgia Capital for those who aren't familiar with it. It's a company that I think is worth studying and getting to know for everyone. Whether you plan to invest because you like the jurisdiction or not, it's a business holding company that obviously, as the name suggests, right? It has its economic interest in Georgia, not the state, but the country. And it holds a monopoly in the best sectors of the country, right? It owns an 18% stake in the capital of the Bank of Georgia. Then it also has or had, let's say, a water utility. It owns pharmacies, hospitals, schools, insurance companies. You can imagine, right? And their business model is very simple. What they do is buy businesses or consolidate businesses that they find interesting that don't require a large capital investment. The case of the hospital is a bit of an exception, but in general, they prefer asset-light businesses, make them grow, and then sell them. So it's interesting because it's a business that trades at a 40% discount to the net value of its assets, and that discount used to be even greater, right? It had reached 60% and so on. And what they do is, with almost all the cash they generate, besides deleveraging the companies and continuing to improve the businesses, they buy back shares. They are buying back about 0.1% of the shares per day, which is absolutely insane, especially given their position. As you said, well, what's the problem? That since it's in Georgia, it's either not of interest or doesn't seem to attract much interest, although you've already seen the chart, right? This is a textbook compounder. They compound their NAV at 10 to 15%. Their target is above 15%, but they've had ups and downs, let's say historically, and no one is following them. So we do follow it, and we also have an analyst who is Mr. Kamikaze, who is truly a well of wisdom, especially when it comes to Georgia. He follows it to the letter, and we've put together a comprehensive report on the pharmacy business of Georgia Capital, evaluating it. First studying it, obviously, right? And then we ended up assessing how much this could be worth. I won't give too many spoilers, but we do believe that right now, Georgia Capital is trading at the value of its stake in Bank of Georgia, and the pharmacy retail business in a few years could be worth as much as this business, which is already the entire market cap of the company, and it's just one of its segments, right? So, well, it's a real capital compounding machine, which we absolutely love. Obviously, it has geopolitical risks and other types of risks, right? Because it's based in Georgia, but it also doesn't get any coverage. So it's uncharted territory for an analyst and true paradise for those of us who are passionate about this.
And now Golar has also just released its results. You're going to prepare for this weekend, or I think for, yes, a note, let's say, with the opinion of W Financial Research from the bank's analyst team. We also have in the portfolio, which is also set to be released this weekend, the thesis of a company, right? It's better if we don't say that it's in the model portfolio, but it's true.
And then regarding sector reports, it won't be much of a spoiler to say that we're preparing and almost finished one on the restaurant sector. And we also have one in the pipeline, or rather under study, on the luxury sector, which we know are two areas of interest. What is our goal with all this? Well, it's really to provide coverage for many more sectors, because we won't necessarily be investing in all of them at any given time, but having ongoing professional standardized monitoring allows you to have the groundwork done when an opportunity arises, right? So the more we know about the sectors, as I've done many times before, Emeritus, right? It's knowledge that doesn't expire. Knowing about all the sectors, building up that knowledge allows you to connect ideas, and sometimes there will be opportunities and other times there won't, right? So in the portfolio, obviously, we'll be looking at which ones are the best at any given time, in this case, the ones that interest us most, but we're already going to cover the restaurant sector and the luxury sector. And I see we have another question as well, Antonio from Raul, who says, I don't know if I'm late, but Golar has released its results. Can you talk about that? Look, we're going to include them in this week's newsletter. Well, in the paid commentary newsletter, but in the free one, you'll already have some commentary. So I encourage you to subscribe. And the most interesting thing about everything they said, in the end, obviously the financial part is interesting, but the best part is their comments. And it's that they see the company as very undervalued, and they're really seeing quite a few opportunities for new FLNGs. They mention 5 projects that are already under development by some companies and many opportunities. And it's very likely that soon we'll have an announcement about reserving space at a shipyard and placing long-term orders for parts, let's say the ones that take the longest, to build a 4th FLNG unit for Golar. And if we look a bit at the timing from last year, it's been about 6 or 7 months between the start or announcement of construction and the announcement of the contract. All right. So if we had it now, then by the end of the year, or maybe a bit earlier, we could expect a contract. And once they have a contract, they're already talking about a 5th unit. In other words, it seems like they have a couple lined up. Some tidbits they gave us. Well, it could be that specifically with Kosmos, with the GTA part, they decide to expand the scope of the project, almost doubling it. And then they could even swap out the current unit for a Mark III, which has doubled the capacity, and relocate the smaller one since there's more interest. it's easier to place a smaller one because there are more projects where it can be put to use, right? Compared to the larger ones, which require real giants and top tier projects. So I think there are quite a few short to medium term catalysts, let's say for this very year, such as the announcement of a fourth and even, why not dream of a fifth unit.
Yes, that I really liked when I saw a comment you made about Golar, which are reflections we sometimes don't have about the growth a company can achieve. And you were talking about how a company's growth on the stock market, I mean, right? I mean, on the stock market. Many times it's a continuous movement, and other times it's discrete. Continuous means it goes, let's say, with a certain trend, and discrete means it can jump depending on announcements, right? And that's why you have to be patient and also be careful with selling calls, as you mentioned.
Yes, because for example, with Georgia Capital, if you saw the chart Antonio shared earlier, well, this is clearly a company with continuous growth, right? They try to create value day by day by improving their businesses, and in addition, by compounding the net asset value, the NAV, at a rate of about 15% per year, and so on. So this is the classic chart of a compounder. On the other hand, with Golar, since you depend on, well, there was obviously now I think it's undervalued given what it has. But beyond that, obviously the new contracts and new units will be what make it go up, right? Or really make big jumps. So if you sell covered calls in Georgia for a month, it could be that it goes up a lot for some reason, etc. But in general, it seems like a reasonable strategy. But if you do it with Golar, not so much. Why? Because if nothing is announced, it's fine. But if something is announced, you miss out on all the upside because the jump is going to be discrete unless you sold it very, very out of the money. And therefore, the return is pretty mediocre. You're almost certain to miss the jump due to the catalyst. So you also need to know what kind of company you're working with or managing.
If you agree, Albert, let's go with the last one. Salesforce Andres is asking us, Salesforce the other day, look at how things are, huh? The other day at a lunch I attended, the name Salesforce came up specifically about whether it could be one of the companies where artificial intelligence makes things really tough for them or not. Do you have an opinion, Albert?
And what did you conclude, Antonio?
Well, so there, we concluded, I don't know it very well, but we concluded that Salesforce's strength is really the CRMs. And the good thing about CRMs is that when they're implemented in a company, the switching cost is huge. But it's also true that in the end, it could be a very, very disruptive technology because of artificial intelligence. Hmm.
Yes.
And here you stay 628. Novo and Sudongray from the market side. I think I've never heard you talk about it. In my opinion, they weren't worth 50 times earnings last year, nor are they worth it at 3cc either. Well, look, this company also came up the other day in the conversation we had, and the thing is, let's see, what's the problem with one of the problems with Novo Nordisk? I don't know, Albert, if you want to give your opinion now, right? But the thing is, in the United States, Lilly is very strong. So Novo Nordisk, of course, the market for me, I think that, as you said, the 50 PE ratio they gave it was assuming it was going to get a very large share of the GLP-1 pie. And Novo Nordisk is a company whose revenues depend heavily on GLP-1. I always get confused. I think Novo Nordisk is Ozempic and Lilly is Wegovy, but I always mix one up with the other. It doesn't matter. The main component is GLP-1, the famous Ozempic for weight loss. They've also made a significant leap with the fact that it now seems it will be useful for other purposes, apparently also for fatty liver and so on. What happens is that, as always, it ends up being something similar to the discussion we had at the beginning about AI. Is it clear that GLP-1 is going to be something very important for people's lives? I think so. It's a medication that has come. Today, I read a study saying that the reduction in obesity will also lead to a significant decrease in stomach cancer. So I obviously think it's a good thing. Another matter is what the market has already priced in, as we mentioned, with AI. No one doubts that AI is going to be a revolution, just as the internet was in its day. The question is about valuations. I don't know, Albert, if you have any of these companies. In the research, there's a lot of talk, not just about these companies, which are discussed too. I mean, in the Premier, in the Discord, where all the members talk and share very valuable opinions, but also about the other side. There's kind of a debate. Understand what I mean by debate. Oscar Health, Unit Health, which one stands out there? And I also learn a lot, and I'm sure you do too, from the community itself, right? There are 1,000 people investing, each one contributing. Look at this idea, look at that one. In the end, it's like you said, the hive effect, right? It adds up.
Yes, in fact, I'm also working with one of our users who really follows it closely, which is Farfetch, on a report about this, right? Because in the end, we have insiders from the sector, people who know it very well, etc. And obviously, it doesn't make sense not to take advantage of this knowledge, even if it's not our specialty or focus up to now. At Novo, it's been discussed quite a bit, and we also have some insiders from the sector who know it inside out. I don't personally follow it much, but as you said, it's interesting to take advantage of this hive mind. And there are, well, more than 1,000 of us, all still in the private Discord, right?